In this video, I'm going to show you how to calculate the current ratio, and then I'm going to talk about ways that you can apply the current ratio to evaluate a firm's health. So the current ratio is a measure of short-term liquidity. When we talk about short-term liquidity, what we're basically trying to determine is whether a firm is in a position to pay its bills, its obligations that it's going to have in the coming year. So let's just get to the nitty-gritty and look at the formula for computing the current ratio. So in the numerator, we have current assets, and in the denominator, we have current liabilities. So when we think about the things that are included in current assets and current liabilities, in the numerator here, we're going to have things like accounts receivable, we're going to have cash, we're going to have inventory, we're going to have, maybe the firm has some kind of short-term or marketable securities. So these are the common things that we would find in current assets. And then in current liabilities, the main thing that's going to stand out is going to be accounts payable. And then also you'd have like the current portion of long-term debt. Current portion of debt. So we've got our obligations that are going to be coming due in the next year. And then we've got the most liquid of our assets, right? So our cash obviously is cash, so we don't have to worry about liquidity there. Accounts receivable can easily be factored and turned into cash. Securities can be easily turned into cash, and we'd like to hope that our inventory can be turned into cash. So when we think about these things, what we're really trying to do here with this current ratio is say, okay, what is due in the next year, and do we have enough assets that are liquid that could cover those obligations? And so let's use an example here. We're going to look at a couple firms, and bear in mind that a higher current ratio is going to imply higher liquidity. Okay, so let's put some numbers to this. We've got a couple firms here, and let's say that in terms of current assets, firm 1 has $270, and then firm 2 has $320. And then in terms of current liabilities, firm 1 has $225 in current liabilities, and firm 2 has $400. Now we just want to calculate the current ratio. So let's go back and let's look at this simple formula. We just take the current assets and divide by current liabilities, and then the higher the number is going to imply higher liquidity. So let's scroll back down. So we just take, for each firm, we just take the current assets divided by the current liabilities. And so for firm 1, I've already done the calculation, and it's going to be 1.2 is the current ratio. Let me just put that over here so you don't get confused. Current ratio we're computing. So 1.2 for firm 1, and then for firm 2 it's going to be 0.8. 0.8, right? We just take this 320 and divide it by the 400, and that gives us 0.8. So let's think for a moment and say, is this intuitive, what we did? Because we've got a higher current ratio for firm 1, so that's implying that firm 1 has higher liquidity. So let's think about, is this intuitive? So firm 1 actually has more current assets than current liabilities. So if we were to subtract, if we just forgot about computing this ratio for a moment and just set that aside, and we were to subtract the liabilities from the assets for firm 1, we would have a positive number. In other words, there are more current assets than there are current liabilities. And that implies that the firm is liquid, right? Relative to firm 2, we'll look at firm 2, and we have a situation where actually current liabilities are more than the current assets. So just assuming right now that the firm had to take whatever current assets it had and try and pay off its current liabilities, firm 2 would be in more of a bind potentially than firm 1. Now, one caveat to that is that this current asset figure is including inventory. Right? So inventory, if the firm is having some kind of financial problems, or if there's a downturn in the economy, there's some kind of problems, then inventory could be a big question mark, right? Let's say there's a depression or a recession. The firm might have trouble moving some of its inventory, and so the inventory might not be that liquid. It might be something we say, well, maybe we don't want to include that in current assets. We know that receivables and cash and marketable securities, those are liquid, but inventory in certain times might not be that liquid. In such cases, the current ratio might not be the thing that we want to be looking at. Would actually look at something called the quick ratio, which is what we're going to talk about in the next video, and it's something that's basically the same thing as the current ratio except it excludes inventory.